If you receive the UK state pension, pension credit, or another DWP benefit, you need to pay very close attention to what is happening in August 2026. Because this month is not just another ordinary month for pensioners. There are 4 separate developments you need to know about, and each one could affect your money, your payment timing, your tax situation, or the way you prepare for the months ahead. One involves HMRC letters that could arrive through your front door. Another could change the exact day your DWP money reaches your bank account. A third involves the state pension age transition that is already affecting people born around 1960. And the fourth could give us an early indication of what pensioners might receive when the state pension increases again in April 2027. And here is why I want you to stay with me until the end. The 4 changes are connected. A letter from HMRC could mean you need to take action. An earlier DWP payment could look like extra money when it isn't. Your state pension age may not be exactly what you thought it was. And the emerging figures for next year's increase could affect how confidently you plan for winter and beyond. So don't just listen to this as another pension update. Listen with your own situation in mind. If you're already receiving the state pension, check your payment date. If you're receiving other DWP benefits, check whether the bank holiday affects you. If you are approaching state pension age, check your exact date. And if an HMRC letter arrives, don't leave it sitting unopened. Let's start with the first change because this one could potentially cause the biggest headache if you ignore it. From the 12th of August, 2026, HMRC is beginning a mass mailing of simple assessment letters, referred to in the reference information as PA 302 notices, to pensioners across the UK. Now, when some people hear the word HMRC letter, they immediately become worried. So let's slow down. Receiving one of these letters does not automatically mean that you have done something wrong. The issue is that some pensioners may have income that takes them above the relevant personal allowance. And this is becoming increasingly important because the state pension has increased while the personal allowance has remained frozen. According to the figures in our reference material, the full new state pension for 2026-27 is £12,547.60 per year, while the personal allowance is £12,570. That leaves only a very small gap. And this is where things become important. If you have other taxable income, perhaps a private pension, savings interest, or earnings, your total income could go above the personal allowance. That can result in an income tax liability. And that's why some pensioners may receive an HMRC simple assessment letter. So here's your first action for August. Check your post. Especially from the 12th of August onward. If you receive an HMRC letter, don't throw it into a drawer and tell yourself you'll deal with it later. Open it. Read the figures. Check the income HMRC has included. Check the amount they say you owe. And most importantly, check the deadline. The reference information says that an August 2026 simple assessment for the 2025-26 tax year gives a payment deadline of the 31st of January 2027. That means you don't necessarily have to panic and find the money tomorrow. But you absolutely do need to understand what the letter is saying. And here's another point that could save you money. If you believe HMRC has calculated your liability incorrectly, don't simply ignore the letter. The reference material says you have 60 days from the date of the letter to challenge the calculation. That could matter if income has been included incorrectly or if relevant allowances have not been properly accounted for. So remember this simple rule. HMRC letter? Open it. Check it. Understand it. And if something doesn't look right, take action within the stated time frame. Don't wait until a deadline has passed. Because ignoring a financial letter rarely makes the underlying problem disappear. Now let's move to the 2nd August change. And this one is much simpler, but it can still catch people out. Your DWP payment date may move. Not because your benefit has changed. Not because you've lost entitlement. But because of the bank holiday. Monday, the 31st of August, 2026, is the summer bank holiday in England, Wales, and Northern Ireland. Banks are closed. And when a regular DWP payment is scheduled for a bank holiday, the payment can be made on the previous working day. So if your normal payment is due on Monday the 31st of August, the reference information says you should expect it on Friday the 28th of August instead. That sounds like great news. You get your money early. But there is something very important you need to understand. Your September payment doesn't necessarily arrive early just because your August payment did. Your next payment remains tied to your normal schedule. That means the gap between the August payment and your September payment can effectively become longer. And if you're managing your household budget very carefully, those extra days matter. This is where people can accidentally make a mistake. They see the money arrive early. They think, great, I've got my payment. Then they spend according to their usual monthly routine. But because the payment came early, they may reach the end of the month with less money available than expected. So don't treat an early payment as extra money. It isn't a bonus. It is your regular payment arriving earlier. If your normal DWP payment is due on Monday the 31st of August, make a note of Friday the 28th of August. And then look ahead to your September payment date. Make sure the money stretches across the entire gap. This is especially important if you have rent, utilities, food, prescriptions, or other essential expenses coming out automatically. And remember, this particular bank holiday arrangement applies differently across the UK. The reference material notes that Scotland's summer bank holiday falls earlier. So don't assume another person's payment date is automatically yours. Check your own payment schedule. Now, let's get to the third change. And this one is extremely important if you were born around 1960. Because your state pension age may not be exactly 66. And it may not yet be 67 either. The UK is currently moving through a gradual transition from a state pension age of 66 to 67. For people born during the transition period, the exact state pension age can vary by month. According to the reference material, people born between the 6th of April, 1960 and the 5th of March, 1961 can have a state pension age somewhere between 66 years and 1 month and 66 years and 11 months. That means two people born in different months can have different state pension ages. And this is precisely why you should not rely on what a friend, neighbor, or family member tells you. Your date could be different. Your state pension age is personal to you. So if you're anywhere around this age group and you're not completely certain when your state pension becomes payable, check your exact date using the official state pension age calculator. Don't guess. Don't assume it's automatically 66. And don't assume it's automatically 67. Check. Because if you've already reached your state pension age and haven't claimed, you need to understand your options. The reference material specifically highlights the possibility of requesting backdating of up to 12 months. And depending on your circumstances and eligibility, that could represent a substantial amount of money. The reference transcript uses the full new state pension as an illustration and notes that 12 months of backdated payments could be worth more than £12,500. That's why this isn't something to casually postpone. If you think you may have reached state pension age already, investigate it. Check your exact date. Check whether you have claimed. And if you haven't, find out whether backdating could apply to your situation. Do not assume. Do not leave it for another 6 months. And don't base your decision solely on a number you've heard online. Your individual circumstances matter. Now here's where the fourth change becomes interesting. Because while the April 2027 state pension increase isn't official yet, August is giving us clues. And this is where many pensioners are going to want to pay attention. The state pension is protected by the triple lock. The basic principle is that the state pension rises each April by whichever is highest of three measures: inflation, average earnings growth, or 2.5%. The exact figure for April 2027 won't be known until the relevant data is available. But August is part of the period when the economic numbers that feed into forecasts are being watched closely. And according to the reference material, inflation has been around 2.8% over the summer, while wage growth data is also expected to be around a similar level. If those figures ultimately point toward roughly 2.8%, then the April 2027 state pension increase could potentially be around that level. But I want to make something very clear. That is a forecast. It is not the official April 2027 increase. And this distinction matters. You may see headlines online claiming that pensioners are getting a specific amount next April. Be careful. A forecast is not a final announcement. The final figure depends on the relevant data and the triple lock calculation. So don't change your entire financial plan based on an early estimate. Instead, use the estimate as a planning signal. And there is another reason this matters. Energy costs. The reference material points to the upcoming energy price cap announcement as something pensioners should watch because winter household costs can have a major effect on a fixed income budget. Think about that for a moment. Your state pension could rise. But if energy, food, housing, transport, and other household costs rise at the same time, the headline increase may not feel nearly as large in your everyday life. That's why the smartest thing you can do isn't simply to ask, "How much will my pension increase?" Ask, "How much will my essential expenses increase?" That is the number that matters to your household. So if you're a pensioner, August is actually a good time to look ahead. Don't wait until November. Don't wait until your winter bills arrive. Look at your current monthly spending. Look at your energy costs. Look at your food budget. Look at your regular DWP income. Look at your savings. And ask yourself one simple question. If my income rises only modestly, will my current budget still work? If the answer is yes, that's reassuring. If the answer is no, August gives you time to prepare. And now let's put all four developments together. Number 1. HMRC. From the 12th of August, watch your post for a simple assessment letter if you're potentially affected. If you receive one, open it immediately. Check the income figures. Check the tax calculation. Check the deadline. And if you believe something is wrong, challenge it within the appropriate time frame. Number 2. DWP payment dates. If your normal payment falls on Monday the 31st of August, the reference material says the payment should arrive earlier, on Friday the 28th of August. But remember, early does not mean extra. Budget that money carefully so it lasts until your next scheduled payment. Number 3. State pension age. If you were born around the 1960 to 61 transition period, check your exact state pension age. Do not rely on a general age like 66 or 67. And if you've already passed your state pension age without claiming, investigate whether you may be able to backdate your claim. Number 4. April 2027. The early economic signals could point toward a more modest state pension increase than the previous year's rise. But nothing should be treated as final until the official calculation is available. And this is the bigger message I want you to take away today. You don't need to panic. You need to prepare. There is a huge difference. Panic makes people react to headlines. Preparation makes people check their own circumstances. So don't let an alarming headline about HMRC scare you into making a rush decision. Don't let an early DWP payment make you think you've received extra money. Don't assume your state pension age based on someone else's birth date. And don't treat an early forecast for April 2027 as a guaranteed payment. Instead, check the facts that apply specifically to you. Your letters. Your payment dates. Your state pension age. Your income. Your household expenses. Those are the numbers that matter. And if you know another pensioner who could benefit from this information, send them this video. Especially someone who is approaching state pension age. Especially someone who receives their DWP payment on a Monday. And especially someone who might be confused when an HMRC letter arrives. Sometimes one simple reminder can prevent someone from missing an important deadline. Before you go, I want you to do 3 things. First, check your bank account schedule for August. Second, check your post carefully from HMRC and don't ignore official correspondence. Third, if you're anywhere near state pension age, verify your exact date rather than assuming. And then keep watching for the official updates surrounding the April 2027 state pension increase. Because when you're living on a fixed income, small changes can become big changes over an entire year. Your money matters. Your time matters. And your peace of mind matters. If this update helped you understand what's happening in August 2026, subscribe to the channel and turn on notifications so you don't miss the next pension update. And tell me in the comments, which of these 4 changes affects you most: HMRC letters, the August payment date, state pension age, or the April 2027 increase. I'll see you in the next update.